Hi there. Welcome to Sumit Academy. I do hope that you're keeping up with my videos. Do subscribe now so that you do not miss out on my previous or future videos. In this video, we shall talk about sovereign credit rating. Recently, India's credit rating moved one step closer to junk after Moody's downgraded the nation to the lowest investment grade level and surprised economists by keeping it on a negative watch. Moody's reduced the long-term foreign currency credit rating to Baa3 from Baa2, with the outlook implying it could cut the rating further. Now, this action brings its rating in line with the BBB minus assessment from S&P and Fitch. So, is this a worrying factor? What is this sovereign credit rating all about? A sovereign credit rating is an independent assessment of the creditworthiness of a country or sovereign entity. Sovereign credit risk, which is reflected in sovereign credit ratings, represents the likelihood that a government might be unable or unwilling to meet its debt obligations in the future. A credit rating agency evaluates a country's economic and political environment to assign it a rating. Obtaining a good sovereign rating is usually essential for developing countries that want access to funding in international bond markets. Is that why countries want this rating? In addition to issuing bonds in external debt markets, another common motivation for countries to obtain a foreign credit rating is to attract foreign direct investment or FDI. Many countries seek ratings from the largest and most prominent credit rating agencies like Standards and Poor's, that is S&P's, Moody's and Fitch ratings to encourage investor confidence. While there are also a number of smaller agencies that offer ratings, these three agencies have the most influence over market decision makers. Several key factors come into play in deciding how risky it might be to invest in a particular country or region. They include its debt service ratio, growth in its domestic money policy, its import ratio, and the variance of its export revenue. Now, what are the examples of sovereign credit ratings? Standard and Poor's gives a BBB minus or higher rating to countries it considers investment grade, and grades of BB plus or lower are deemed to be speculative or junk grade. Moody's considers a Baa3 or higher rating to be of investment grade, and a rating of Ba1 and below is speculative. In addition to their letter grade ratings, all agencies also provide a one-word assessment for each country's economic outlook: positive, negative, or stable. Since they were introduced in the early 1900s, sovereign credit ratings have had a very turbulent history. The rating agencies were taken by surprise after the Great Depression caused 21 out of 58 nations to default on their international bonds between 1930 and 1935. And since then, more than 70 governments have defaulted at least once on their domestic or foreign currency debt. So, how are sovereign ratings calculated? Rating agencies use a variety of quantitative and qualitative methods to calculate sovereign ratings. But in a 1996 paper titled Determinants and Impact of Sovereign Credit Ratings, Richard Cantor and Frank Packer used a regression analysis to narrow down the process to 6 critical factors that explains more than 90% of the variation in credit ratings. First, per capita income comes into play since a larger tax base increases a government's ability to repay debt, while it can also serve as a proxy for a country's political stability. And now you know why our income tax department is trying to increase the tax base. Second, a strong GDP growth makes a country's existing debt easier to service over time, since that growth typically results in higher tax revenues and an improved fiscal balance. Third, high inflation can not only signal problems with a country's finances but also cause political instability over time. Fourth, a country's external debt can be a problem if it becomes unmanageable. Fifth, countries with a history of defaulting are perceived to have a higher credit risk. And finally, more economically developed countries are seen as less likely to default. So, what are the effects of sovereign ratings? Sovereign ratings have many effects on countries around the world. Better sovereign ratings are associated with lower credit spreads. In turn, these lower spreads equate to lower financing costs for countries issuing bonds. A single notch downgrade can raise these spreads by as much as 25%. The effect of these higher spreads and financing costs can lead to 3 main problems. Firstly, inflation risks. Central banks that print more currency to cover current and future debts risk causing inflation, which itself can lead to a number of economic problems. Second, political instability. Countries that are unwilling or unable to print more currency may undergo austerity measures to cut their costs, which can result in civil unrest. And finally, fewer options. Central banks facing high borrowing costs may not find it as economical to provide stimulus packages or other growth incentives during difficult times. Moody's has said that India's growth and credit profile were deteriorating even before the virus outbreak, and those risks will become more pronounced now. The negative outlook reflects strong downside risks from deeper stresses in the economy and the financial system. The risk of another downgrade hanging over India is clearly not positive for external borrowing costs for the government or the corporates. The focus now shifts to Standard and Poor's and Fitch and whether they will lower India's rating outlet to negative or downgrade to junk. With India opening up its high-yielding debt market to foreigners, any downgrade by S&P and Fitch would hurt inflows into a nation that relies on imported capital to fund investment. Pressure on the credit rating may reduce the likelihood of the Reserve Bank buying bonds directly from the government to help finance the fiscal deficit. Moody's action reverses its surprise upgrade in 2017 following the passage of the Goods and Services Tax and the bankruptcy reforms. The ratings company has cut India's outlook to negative within 2 years as growth sputtered and a shadow banking crisis played out. India's policy making institutions will now be challenged to mitigate and contain the latest downgrade with Moody's with a negative outlook. As of now, according to the RBI's Consumer Confidence Survey, consumer confidence fell to the lowest in more than 6 years in May 2020 as people feared falling incomes and poorer employment prospects. Consumers also feared an increase in prices of food products. Here is the latest update. S&P has affirmed its rating on India's sovereign grade of BBB- for the 13th year in a row with a stable outlook. Well, that's going to be a big relief for the government of India. The global rating agency said the country's economy remains a long-term outperformer versus peers at a similar level of income. Standard and Poor, however, said the impact of the COVID-19 outbreak posed a significant challenge to the country's economic growth trajectory. It said the reforms initiated by the government would yield positive results in the long run. The rating agency projected the economy to contract 5% in the current financial year, but said it would grow by 8.5% in financial year 22. Well, that's all from me in this video. Do like this video and do share on your WhatsApp and Facebook pages. And do subscribe to my channel so that you do not miss out on my previous or future videos. And in case you have any suggestions, please do write in to sumitacademy20@gmail.com. Till later then, cheers.